Username here. I'm going to do a trade review from Friday on Tesla, and I'm actually going to break this up into three different parts. First is going to be a trade review. Second is going to be where the three better entries for the same ticker in the same direction would have been. And third, I'm going to go through a daily, just looking at the daily chart and showing how that would have helped me on my trade management on this 1 minute chart. And as you can see from the title, a poorly managed green trade. So it was a green trade. It was a base hit. It was like a 29% trade. And so I can't complain too much there, but it was poorly managed. So I didn't manage it well. But let me walk through it here real quick. So my entry was just after the 950 candle closed, and it was right here. And you can see I have little arrows here. This is my, over on this side is the chart for the ticker, or for the option. So this shows my entry, and they got a little flag there showing I got 5 contracts at 296. So there shows my entry, and then here would show my exits and the exit costs up there. So let me walk you through the 5 minute chart, what the 5 minute chart looked like in terms of why I actually got in. So it was a gap down, and we opened and pushed up, which isn't unreasonable when you gap down like that, because there are probably a lot of people who shorted and needed to buy back, or there are a lot of people who are long and are like, you know what, I'm not interested if it's going to go back down. So it does make sense that when you gap down, that you're going to come up here and we did exactly that. We popped up here, and then we rejected, strong rejection on this candle. Ended the candle on the low of that candle, barely ticked up here, and continued strong down. And then the next 5 minute candle was just arguing between these two levels. So the good thing about this is that it tells you that this is the current day open is going to be an important level, and that this daily emerging 222 cents is a significant level as well. It's just above the 200, the psychological 200, but so that is confirmation that this is the range we're working in. So what I was looking for was a close under $200.22. That was going to be my entry. Was going to be a 5 minute close under that. And the very next candle after this is I entered at the close of this candle, so the first few seconds of the next candle, because it not only did it close below here, but the one thing that was going to concern me was if it closed below the 222 cents, but it closed above the 200, the psychological 200, because then there's pretty decent risk for a bounce. But it closed below both. It closed 199.84. So I entered just as right after that candle closed. And I got into 5 contracts here, and the very first thing it did was something you don't want to have happen, but it happens, and is it pulls back. So if you look at this, I did not want, we were fighting between these two levels. I did not want to have a pullback that came all the way back up here, right? I didn't want to be in this fight again, or even in a similar fight. So I had decided that if it was going to try to come back up into this range again, about 200 to about 202, which was a little bit higher than each, I was going to cut it at the halfway point. So just a little bit above these candles here, we were going to be out, and it was going to be an ugly out. It wasn't going to be ideal, but we had such a strong push down that there was enough going in my direction that I felt pretty comfortable on that. And so as I looked at this in my review after the fact, this would have been a really good opportunity, given that this was kind of bear flaggish. This would have been a good opportunity to either double down or at least add to my position. It might not have been a bad idea to double down there, but at least add a couple contracts would have made sense, because you had this bear flag, and now you're pushing down again. And the close on this even on the 1 minute candles, you had a strong drop here with a lot of volume. The next candle was a smaller candle that ended up being a doji that was fighting, a fighting candle, and it was fighting below the level. Then we had lowering volume, low volume as we came up here and played around these areas. And then when this dropped, and obviously when this drops, you're not going to see the volume that it was going to be higher, but you can see it coming in fast enough that you know that it's going to be higher. So, I could have gotten in there. And you might ask, why did I not scale at this level I have? And my trade was really down to here. So the original plan was to scale some out, and I have a conservative scaling point, which this fits that rule I have. My first scale is gonna be in the 15 to 20s. Depends on the ticker and the move and a bunch of things, but this is a good scale for me of these 3 contracts. And I actually took them out one at a time. And one of the things I go back and look at my review is, does it make sense that I would have scaled there simply because of the number? Because I have a range, 15 to 25, 15s and 20s, and it's based on momentum. Well, momentum was going down. This was, once it finally did go down, it was a huge volume. So there was nothing really telling me, which is, it doesn't make sense why I started the scale here. I could have let this go. I didn't want to let it reverse. So I did scale my first one out on this green candle down at the bottom here. I could have, and I had the rest ready. As soon as I do this, I switch, and now I got my stop loss for 4 left. So, I could have managed this to prevent too bad of a loss if this did reverse on me hard. But I really should have waited. This is where this poorly managed happens. If I'm going on momentum, there's no momentum telling me that I couldn't have waited for this next candle. I scaled all 3, and I usually scale either half or a majority of them out at this 20s, because that helps me to feel more comfortable letting runners run, or at least that's the theory. I haven't always done it. In this case, it's a great example of how I didn't. But I could have let it go, and if I would have, I would have seen we've got more, increasing volume as we go down, and I could have scaled one here maybe at the end of this candle, and maybe even one down here at the bottom at the end of this candle, just to see. And then I would have had my 3 scales out, and I still would have had 2 contracts left, one to hold for here, and then 1 runner, or just 2 runners if it blew through this level, maybe even just 2 runners. But it obviously didn't. It reversed, and I ended up getting out for 20%. And by that time, I've gone down far enough that I was able to move my stop loss down. It had been at this level, but I guess I can show you the 5-minute candle is why I did this. So here was the first candle. Here's where I entered. I entered right here in this candle. We popped up and we fought. And then there's the big dropping candle. And now look at that lower shadow. That lower wick is really huge. And then the lower wick on the second one. So I stopped out just above here on the next candle. As soon as the next candle started, I got out in here somewhere. But that almost a tweezer bottom, that tells you that we're going back up. No. Does it tell you that we're going to 100% go up? No. I've seen candles like this turn into a 3-bar play that went down further. But there's more telling you it's going to go up than telling you it's going to go down. So that's kind of why I got out. And it did go up. It came back right up to that level. Put bullish candle here. Came right back up to this current day open, which, I had mentioned before, the fact that this one fought between those 2 levels told you that these were going to be, these were strong levels, and we came right back up here to it. And actually wicked off of it. So that was my trade. It was foolish of me not to notice that I had 4 out of 5 candles hit this and not go below it. and not take some money here. So I left, $100 and some dollars on that contract that was poorly managed. So there's a decent amount there that I should have had. Even if I played these poorly like I did, I should have had another, I should have added on 25% to my trade at a minimum here. And it would have, it still would have been a really good trade. This wasn't a bad trade. 29% is not a bad trade. Is that what it ended up being? 29? I think so. Something like that. Maybe 25. But it wasn't a bad trade. It's a solid base hit. If I had a base hit like this every day, if I had one base hit, and it put me over my daily goal. So I don't have a huge daily goal. When I was trying to trade for money instead of the chart, I just was trading poorly. So now I decreased my daily goal amount, and I just trade better when I'm trading small enough that I don't get greedy. This isn't going to change my life. This dollar isn't going to change my life today, but over the next 2 to 3 to whatever years, yeah, it changes things because you get consistent. And once you do that, and the dollars don't bother you, and you slowly scale up, as opposed to me trying to quickly scale up. So yeah, this isn't going to change my life either way, which is why a base hit like this every day is what I need. But so that's section 1. It's just a quick trade review, why I got in, why I got out, how I managed it poorly, left money on the table. The second one, I'm going to talk about how there were better entries, and here's one that I actually watched this go by. Now, since I'd hit my daily goal, I'm trying to stick better with that. I don't want to give any money back, but this was a much better setup than what I got into. So I got into a setup that, it would not be unreasonable to see this double bottom in reverse, or this was technically a higher low than this previous candle. So yeah, there were some things in this trade that were telling me to do it, but there were also a couple things warning me against it. But this is a much better trade. Why? Because we opened here, we went up over, we rejected, we came down. Now in a short sense, we came down, we retested, we came down, and then we came up and we retested and came up. But if you look at this, we opened, we came way up, came down. This is a bigger move. We came up and retested, and if I switch this to like a 10-minute and look at the same area, you can see that from open, we went down, we retested open, and then we went down again. So from a larger time frame, this is a better move, but also from a candlestick pattern and from a volume aspect, this is a better trade as well. This candlestick pattern is a good reversal pattern. The follow-up, and your risk here. My risk either being a candle close over this, or just going over, above here. You could set it for a few different things. Just if you're already green and you want to run with it, you could risk a little bit just to see if that's going to go down. But if this was your first trade, it would be a really nice trade because it's a solid retest on a higher time frame, and the smaller time frame is also telling you that this is a decent move because it's rejecting again. It's got a high wick and it's rejecting the same one that is, consolidated below here, rejected still below here, and your RR is really, really good. You would anticipate, this one didn't, but you would anticipate going at least down to where you were if this was a larger move and ended up being like a trend day. It didn't in this case, but this would have been a much better entry. And here you're probably from my entry down at this level, I'm probably $1 better per contract on here. So instead of getting in for $300 a contract, I'm getting in for $200 a contract. I could almost scale at the same break here, at the same level that I entered here. Even if it was only 1 or whatever, I could definitely scale down here, which is a level. It just was a better trade. The RR in this trade was much better. given the history and where we were at just intraday and the tests that we didn't push through. So that was one. And then on the 5-minute chart, this is actually a better trade too. You know, if I'm just looking at saying, you know what, I need to let things shake out. I'm not gonna trade for the first 10 minutes. This was really strong, and here's one reason why. Look at the volume on this. Usually your first candle is going to be your highest volume of the morning, if not the day. Sometimes the day. A lot of times at the end of the day you'll get a lot of volume, but for sure that. And then here's a lower volume on the test. So you're, heavy green volume, regardless of the color of this, it's not unreasonable to have this lower volume. But then to have the third candle, the highest volume of the morning, that's kind of like having your pinky longer than any other finger on your hand. Does it happen? Yeah, it happens, but not very much. And when it does, it's telling you something. So that was also why I got in at this candle, even though it was on lower volume. Because if you come back here and look, this was a lower volume, and then this was a higher volume. So to have this a lower volume, this is the lowest candle of the day as a reset, and then this even lower than that, it wouldn't be unreasonable to think that I'm going to have another candle that closes at the very bottom, very bearish candle, just like this one, closed at the very bottom. Nothing to say that we wouldn't get this candle right afterwards on increasing volume. And if you look at what we got, we had to argue a little bit under the level, which is bearish. If you're in a downtrend and you consolidate under a level, or if you have a retest under a level, that's more bearish. It's more continuation. If you're in an uptrend and you have a reset above a level, it's bullish. So in this case, we gap down overnight and we retest, and then we keep going down. So us getting a reset candle underneath this level is still bearish. So did I like the pullback? Absolutely not. Was I worried? Not so much. Not for either of these two reasons. And then what we ended up with is a almost identical candle here. So this price action all made sense. So if you go back here, as soon as you break there, in fact, let's look at the 1 minute. The 1 minute candles here are looking pretty good. So you end, here's where you ended. Here's that little uptick, and then the big push down in the next 5 minute candle. So here was kind of the trigger. If I would have traded this similar to the way I did the other one and entered as soon as this candle closed, I would be in here, and it'd be. I went back and looked, and it was like $1.86 a contract versus the $3 a contract here. So that would have been an outstanding trade, an outstanding entry. And in fact, if I missed that one, just because it moved so fast, here's another really good entry. Why? Because on a 1 minute time frame, we closed a level on increasing volume. We then have our little resting candle, low volume, below current day open. So again, we're in a downtrend. That's more bearish. So I could have entered here. I could have entered here. Those both would have been better entries than mine here. Now, this would have given me an opportunity to get $100 a contract, which I didn't get over here. What did I get? I went from 3 to 360, 365. I got one at 4, so I got one at $100 a contract. But I missed my $200 a contract on my last one. This one I could have, had a couple $100, I could have scalped a couple of them for $100 a contract. And then I would have had to wait through here, but I wouldn't get worried. Even if I entered here, I wouldn't get worried until this actually crossed or closed above current day open, because that's a strong pivot point, right? So both of these would have been a better entry, and this would have been a better entry. Now, again, I'm not complaining about my trade. Don't get me wrong. I'm very, I appreciate the fact that I had that trade, that the market gave me the opportunity and I took it. I fumbled it, I managed it poorly. Wasn't the best entry. I didn't add here, so there's a lot of things I did wrong. And in spite of that, I still was green. So yeah, I'll take what the market gives me. But there were more opportunities, and I would say better opportunities, or at least as good, if not better, good as good. So the market gives opportunities for sure. So that's part two. So section three, I didn't scale out here, and this is an even dollar amount, and I should have thought about that. Even though my daily emerging was down here, my my final target price was down here. I missed this, and it's not just because it was an even dollar amount either. So let's come back here and look at the daily. Let me talk about that for just a second. Let's look at, actually, let's start here. This is what a daily would have looked like before market opened. So we've got this pattern, right? We've got this shooting star pattern. This is the 2/3 of a very bearish pattern. So when you see this, the anticipation is that you're going to gap down, and we already were pre-market. So right before open, we'd already gapped down, and we were in this range. So a couple things can happen. Number one, you can obviously drop down right away. Number two, you could come up and retest this level. It's closing the gap, closing the overnight gap. You retest this level, retest the close. So there is a tendency to retest. Given that we were in a really, really strong uptrend at this point, almost an unbelievable uptrend, and the fact that we had closed over 200, for the second day, there was still some concern on my point that we wouldn't gap down and then just shoot right back up. We had some people who were closing out their positions overnight because we'd gone up so far, but this really is a bearish, 2/3 of a bearish pattern, right? So what you have to think about then is what usually happens. Well, you usually get a mirror image of this one, or something close to it. Maybe not a mirror image, but you get something similar, a similar size of candle. Maybe the wicking's different, but a similar size of candle. It looks like a candle down here. You gap up, you gap down. You have a nice triangle here. So what I failed to realize is my daily emerging level here. Some of the levels that could be in play, you could still have this level be in play. This level, this level, this level. Just the average, the notable levels on these candles. So open, high, low, close. So now let's look at what really happened. We did have somewhat of a mirror image here, right? Gap up, gap down. We came up, we retested. We didn't get all the way up here, but we certainly got past here. So we did some retesting. We filled most of that gap up to the close anyway, but for sure we filled the gap between the shadows. And if I look at smaller time frames, $203, not really. I mean, it had some play around it in the pre-market. Kind of wicked up to it here, but not really 203. 201.33, kind of. Yeah. But for sure, look where the overlap was here. If I go back to if I take this to a 1 minute, and I do have this as a different chart just so I didn't have all the words on this while we were going through this, but if I go back to my 1 minute chart, this is where I didn't scale out, and this is where that candle open was. I mean, they're almost overlapped. So that's something that if I would have paid attention to the daily chart, I should have understood that. I should have put those pieces together. That's something I should have done when I was preparing for this, but it didn't. And it cost me. Obviously, it cost me a fair amount of money. So not only just from mismanaging this, but just from not closing this out for several reasons. Even if I would have had that line there, I don't know. I don't know what I was thinking. But definitely that many tests on that, I should have definitely closed this one out. So that is the quick and dirty 3-part over one trade I took on Friday. And if you have any questions or comments or anything, feel free to post them below, or hit me up on Twitter or in a Discord, and I will get back with you as soon as I can. Other than that, we'll see you next time.